Hello, this is Mijun from United States Stock Hawk. It's time again for United States Stock Elementary School with the man you think of on weekends, Chief Executive Officer Kim In-jong. Hello, Chief Executive Officer Kim In-jong.
Hello, Chief Executive Officer Kim In-jong. Nice to see you.
Nice to see you. The viewers might not know, but starting this week, we've made some changes. We've moved the broadcast time up by an hour. Yes.
So,
Until last week, actually, I usually did the research and filming. And since the Chief Executive Officer was in Korea, we had no choice but to film at 9 p.m. to match the time difference. Sometimes we even finished around 11:30, right? The Chief Executive Officer also has a bit of ambition for broadcasting, so at first we thought we could finish in 40 or 45 minutes.
we always promise to finish in about 30 minutes or 40 minutes at most, but once we start, it ends up taking an hour.
Exactly. There were times when it went over 2 hours, but today it's 8 o'clock in Korea right now. So, in a way, I think we'll be able to start recording the show with a pretty relaxed mindset. But still, don't make it too long. Yes, I understand. We also need to conserve our energy, so it looks like this will air on August 30th. Could you please introduce what you've prepared for this week?
Yes, last time we started part 2 of Mijuchu, and I mentioned that we would go through the investment indicators together. So, among those, we started with valuation first. Last time I talked about the basic concepts of valuation and then about safety, margin, and Mr. Market. And today, finally, we're going to talk about price-earnings ratio. The Chief Executive Officer has mentioned it a lot on broadcasts, and if you're an investor, even if you don't know exactly what it means, you're probably very familiar with things like price-earnings ratio is how many times, but there aren't many places that really explain how to actually use this indicator in practice. Of course, like when we say it's a certain multiple, for example, if NVIDIA is at a certain multiple, then we wonder what multiple advanced micro devices is at. You feel this one is cheaper. There are some limitations to what this really means and how I can actually use it practically. So, in a way, there could be some subjective aspects as well. I'll explain those parts step by step from the basics in the elementary school curriculum. So today I'll be talking about some basic things, but there will also be some examples later on, so I'd appreciate it if you listen with interest.
Yes, since the familiar term price-earnings ratio will come up today, I think many of you will be more interested and pay closer attention. All right, then please go ahead with the lecture you've prepared so thoroughly for today.
Today at United States Stock Elementary School, we'll discuss the price-earnings ratio, and cover 4 main points. So, a brief explanation of what price-earnings ratio is, then the 3 meanings of price-earnings ratio, and how to interpret the price-earnings ratio indicator according to a company's growth stage. I think this part will be practically helpful for you, because looking at price-earnings ratio during the growth stage, the way you look at price-earnings ratio for companies in the maturity stage or those in decline is bound to be different. So I'll talk a little about those aspects. Lastly, the relationship between earnings per share growth rate and price-earnings ratio is actually very important for individuals when it comes to valuation. It's an area that's often glossed over in books and similar sources. Today I'd like to summarize 4 key points that you should definitely remember. If you recall the link between earnings per share growth rate and price-earnings ratio, next, when you look at the indicators accurately, I'll explain so that you can judge whether this company is expensive or cheap compared to its growth rate. Within our choice talk, there are indicators like price-earnings ratio forward, price-earnings ratio, and price-earnings to growth. I'll open one of those indicators and show you step by step how to interpret what we've learned today using each of them.
That's good, yes.
First, now price-earnings ratio. I mentioned this before when we did Mijuchu last time. When we say price-earnings ratio, it stands for price-to-earnings ratio. So we just take the first letters and call it price-earnings ratio. So in Korea, we just call it price-earnings ratio, or sometimes say price-earnings ratio as well. And on some international websites, they sometimes drop the R and just write PE. So you can think of PE, price-earnings ratio, or price-earnings ratio as all meaning the same thing. When it comes to price-earnings ratio, don't just memorize the formula. It's the ratio of PE divided by E. something like that. Price to sales ratio is P divided by S, so the market capitalization becomes the price. Net profit becomes the ON. Dividing by the number of shares makes market capitalization equal to stock price. And dividing net profit by shares gives earnings per share. Whether it's market capitalization divided by net profit or stock price divided by earnings per share, both represent the price-earnings ratio. However, if you calculate it, the price-earnings ratio from market capitalization divided by net profit and the price-earnings ratio from stock price divided by earnings per share differ slightly. So you might wonder, why are these different? I definitely did the calculation, but it's a bit different from what this website shows. The reason is when calculating earnings per share, for example, whether you use diluted earnings per share, which includes potential shares to be issued, or whether you exclude treasury shares when reporting. These kinds of factors when calculating the number of shares cause slight discrepancies. So you can just ignore that kind of difference. Generally, calculating price-earnings ratio by dividing market capitalization by net income is the most accurate way to do it. You can think of it that way. So in the stock market, I often represent this with a lever. It shows how many times you can lift something. This is the value of the company and this is the price. And the lever shows how many times you can lift it. It's the same concept. Lifting more increases the stock's price. Depending on the current mood of the stock market, sometimes you can lift it even more. It's kind of like the role of a vitamin. It's like this. How much is this company going to make? If you don't raise the stock price, it's not good. So if you focus on profits, the stock price actually can't go up much. Focusing on the momentum of the rising stock price means you're focusing on this. Then the multiple goes up much more. So just like how the leverage changes depending on whether it's on this side or that side, we can raise it more or less depending on that. Price-earnings ratio is determined by the intrinsic value of a company, but it can also go higher or lower depending on the mood of the stock market. I think it would be good if you could understand that there are such factors. I'll talk about it again later. Next, the first thing is the standard for price-earnings ratio. We calculate it using net profit and market capitalization, and the market capitalization is clearly shown right now. As for net profit, is it quarterly net profit, semi-annual net profit, or annual net profit? Please remember that the standard for net profit is 1 year. Some complete beginners don't really know this at first. So some people use the quarterly net profit and then say, the price-earnings ratio doesn't come out right. The standard is always based on the annual figures. All valuations are calculated using the annual market capitalization, so it's based on a 1-year period. The reason why the price-earnings ratio values are so different on each side is because, as I wrote below, there are basically 3 main types of price-earnings ratio. For example, today's August 28th, so as of August 28th, the company's performance has been reported up to June 2025. The results for June, March, and last December have all been released up to this point. So, instead of using the current market capitalization, which year's net profit should we use as the standard? Therefore, the price-earnings ratio will all be different. What we usually use is this price-earnings ratio, which is the sum of the most recent 4 quarters. It's also called trailing price-earnings ratio. And in Korean, it's referred to as annualized price-earnings ratio. Usually, when you see price-earnings ratio on general websites, it's almost always this version. Unless otherwise specified, we call it the trailing price-earnings ratio when we divide the current market capitalization by the net profit of the most recent 4 quarters combined. Next, what we often look at is the future. There's something called the forward price-earnings ratio, also known as expected price-earnings ratio, or sometimes shown as price-earnings ratio, F, on some sites. That refers not to the current expected value, but to the projected future quarters, meaning it includes the profits of upcoming quarters. But if you look, I've listed 2 different forward pairs. It includes 2 past quarters, but with 2 quarters left in the year. By year end, there are 2 confirmed and 2 projected results. This annual figure is called a forward price-earnings ratio. I actually want to calculate the price-earnings ratio not for this year, but for the next year, or for the next 1 or 2 years from now. That's also called a forward price-earnings ratio. So some companies write it as forward price-earnings ratio 1 year or 2Y. That means T+1, T+2, and forward price-earnings ratio refer to 1 or 2 years from now, which is why their price-earnings ratio values differ. So when I talk about something being expensive or cheap based on the price-earnings ratio standard, whether I'm talking about trailing forward or T+1 forward, the values are all different. So it's right to standardize that basis before discussing or saying something is expensive or cheap. Let me mention this first, although it's rarely used. There are times when this is used and indicated. Sometimes the price-earnings ratio uses finalized annual net profit up to 2024, which is called the historical price-earnings ratio. But it's rarely done. But Korean portal sites and places like that, they kept using this price-earnings ratio until a few years ago. But on the site we ran, we were using this trailing price-earnings ratio. So since the price-earnings ratio value on the big portal sites was different from the one on our site, members kept calling us. They said our site seemed to be wrong. Simply put, they thought there was no way a big portal site could be wrong. So why was there always a difference in values here? Then we explained that ours is based on the sum of the fourth quarter. As for what the portal site uses, we told them to ask the portal site about that. To determine their standard, we worked backwards due to the many questions and did the reverse calculation to find out. They used past annual figures. So this is different for each company. So knowing this standard, it would be good to take a look at the price-earnings ratio. I'll summarize it for you first, and then the three meanings of price-earnings ratio. And this is something that's good for you to keep in mind. Let me give you an example. Imagine you're running this grocery store. Let's say you run a grocery store, and after subtracting all the expenses from the annual sales, not just the gross sales, but after all costs, you end up with about 100 million won a year in net profit. When you think about running a grocery store, so the question is, if the annual net profit is 100 million won, what would your selling price be? On the other hand, if you are the buyer, you want to take over this and do something with it. Then, if you think about it, at what price would buying that not be too expensive for me? And if I buy it, how much profit could I make? Would you like to think about that? Then you'll probably start thinking about something in your head like, at what price would I buy it? But now, this standard will definitely be different for each country, because each country has a different expected rate of return. Since they're all different, it has to vary depending on the country's interest rate level or loan interest rate level. So if it were you guys, let's say you have a store with a net profit of 100 million won. For example, our Chief Executive Officer, Ji-hoon Mi, has a grocery store that makes a net profit of 100 million won a year. And I go there and... What if I offer to buy it for 1 billion won? Would you consider selling it? I would.
If yearly net profit is 100 million won, if it increases next year and then increases again the following year, then 10 times seems a bit cheap. And if
It's 100 million won every year.
it's 100 million won every year, then 10 times would be fine, even if you borrow from the bank. Interest is about 4% these days, right? The bank rate is...
Yes, it's 4%, maybe 5% tops, right?
Borrow at 4 to 5% interest to get a 10% return now.
That's right. So
If it's 10 times you have to buy it, this is really cheap.
sellers want higher prices, buyers want lower ones, and this sets the price. In the stock market, it's mainly about annual net profit. Dividing this by shares gives the earnings per share people buy and sell stocks daily based on what they'll pay or accept for that earnings per share. But when we actually buy and sell, we hardly ever look at that. Instead, all we care about is whether it can go up more. I bought it for 1 billion won, but is there someone who will buy it for 1.5 billion after me? If there is, then you judge it as cheap, and if there isn't, you judge it as expensive. So it's the same in the stock market. Just like in the real world, you need to focus on net profit. I just wanted to mention this as an example. For example, when we say the price-earnings ratio is 10 times, what does that mean? It has three meanings. First, price-earnings ratio of 10 means that the stock is traded at 10 times its annual net profit. Second, if I buy this for 1 billion won in a year, with a net profit of 100 million won, buying at 1 billion won gives a price-earnings ratio of 10. If the net profit is 100 million won every year, then in 10 years you would recover the entire 1 billion won. This is also known as the investment principal recovery period, or simply the time needed to recover your investment. Because the asset value is 1 billion won, it takes twice as long for my assets to double. It's the same as saying the number of years it takes to double. So if it's 10 years, my assets double. Then you evaluate whether that's good or not. Third, now the concept of return on investment that Mr. Dapio mentioned earlier comes into play here. Investing 1 billion won and getting a tenfold return, you make a net profit of 100 million won. So if you invest 1 billion and earn 100 million, that's 1/10 or 10%. So this means it's the expected annual rate of return. So if you look here, the inverse of the PE ratio, it's 1 divided by the PE ratio. If you look at this, 1/10, the bottom part is the market capitalization, and the 1 is the net profit. Since the numerator and denominator are reversed from the original PE ratio, this is its inverse. The book states that the inverse of the PE ratio represents the expected rate of return. So, when discussing the PE ratio as a future multiple, it's best to keep this concept in mind. Next, applying these parts in practice becomes very difficult. The reason is Nvidia announced its earnings again yesterday. Nvidia's price-earnings ratio, according to the data currently shown on our site, is 57.8 times, 57.8 times. Now, I've recorded this again using the 3 meanings mentioned earlier. First, you're paying 57 times the annual net profit to buy Nvidia. It takes 57 years to recover your initial investment. Wow, it feels like I'd have to pass this on to my descendants after my funeral. Isn't that way too expensive? Third, the expected annual return is 1 divided by the price-earnings ratio. So 1 divided by 57.8 is about 1.7%. So if I can only expect 1.73% from NVIDIA, should I even buy the stock? You start to doubt it. If NVIDIA, his stock rises 50% a year, why is the expected return just 1.7%? These kinds of things start to mix in with the arguments about whether price-earnings ratio is useless or if price-earnings ratio is really accurate. So if you build a solid foundation, later on you'll be able to see whether that 57 or 58 is cheap or expensive. Right now, if you just look at these 3, they're really expensive stocks. The chief executive officer said he might buy at 10 times, but over 20 is too much. Yet we're buying at 57 or 58 times. So, if I explain why these things change in practice, the starting point is we assumed that the recovery of the investment principal would be the same every year. Net profit remained 100 million won yearly, but what kind of company was Nvidia? In the first year, it earned 100 million won in the second year, 500 million in the third year, 1 billion, and then 2 billion after that. Yeah, you only need to make about 5.7 billion won, but it was actually earned in about 5 years, not 57 years. So it's correct to say that the actual price-earnings ratio was about 5 times. That's why it's very important to estimate the price-earnings ratio or approach it by summing up the net profits you will earn in the future. The printed 57 or 8 doesn't matter. Focusing on that just makes it seem expensive. But this 57 or 8 assumes that the net profit will be the same every year. So depending on what the net profit growth rate is, 57 or 8 can be expensive or cheap. So when we look at the price-earnings ratio, we need to look at it together with the earnings per share growth rate. Or we should look at the forward price-earnings ratio. Looking at the forward price-earnings ratio means reflecting the next year's net profit. So whether you look at the forward price-earnings ratio, the earnings per share growth rate, or the earnings per share growth rate reflected here, dividing the price-earnings ratio, which shows earnings per share growth, by the earnings per share growth rate. We call this price to earnings to growth gross rate. So you need to look at the price earnings to growth, or consider all of this together to judge whether 57 or 8 is reasonable. You shouldn't just think 57 or 8 is expensive. Price earnings ratio is 98. How can I buy this? It doesn't really take 98 years. It only adds up to about 10 years. So you should think of this company's price-earnings ratio as 10 times when you buy it, not 98 times. That's what I wanted to tell you today. Today I want to stress this for the first time. Please try to understand this before you leave. So if you look at our Toy Stock website, when you search like this, you'll see these 4. Price-earnings ratio F, forward, price earnings to growth, and price to sales ratio. So let me explain what these indicators are calculated with before we move on. So first, price earnings ratio is the trailing price earnings ratio. As I mentioned earlier, trailing price earnings ratio is calculated by dividing the market capitalization by the sum of net profits from the most recent 4 quarters. This trailing price earnings ratio it's an indicator of past and current earnings and performance. But we're mainly interested in the future stock price, whether it will rise. That's why the future price earnings ratio matters more. If the trailing price earnings ratio is low, it's a cheap stock. But even if the trailing price earnings ratio is a bit high, if the forward price earnings ratio is low, it could become a cheap company, so you should check its forward price earnings ratio. The forward price earnings ratio that we're currently showing on our site
is being displayed like this.
We're showing the price earnings ratio based on the annual earnings per share, that is, the annual net profit, up to the year-end settlement data. After the 3rd quarter, we stop using 2025 data and switch to 2026. That's why the forward value... We're currently using 2025 as the forward net profit. When September arrives, just 1 month remains. When September comes, the net profit used as the basis for this forward price earnings ratio moves to the next year. So you can understand that we're using a forward period that's about 1 year to a year and a half ahead. Next, the indicator called price earnings to growth is the price earnings ratio divided by the earnings per share growth rate. And this expected earnings per share growth rate is... We're using the forecast. We're not using a fully forward-looking estimate. Instead, we're taking a more conservative approach with this one. So, the lower this price earnings to growth ratio is, the better. Generally, we consider a price earnings to growth of around 1 to be reasonable. People like Peter Lynch say that if it's 0.5, it's really cheap. It's risky to sell your house to buy it. But that's how attractive a stock is when its price earnings to growth ratio is 0.5. Now, if you think about this advanced micro devices stock, it's currently at $167, but it had climbed up from below $100. So basically, its stock price has gone up by more than 60% recently. Then what was the price earnings to growth before it went up by 60%? Quiz. So this is just arithmetic. But if 0.7 increased by 60% to become 1.6, since the increase is 0.7, you just need to divide it. Then it's roughly about 0.4 or maybe 0.3 something. It's around 0.4. That means the price earnings to growth was less than 0.5. But the price earnings ratio probably wasn't quite that low either. It was probably around 70 times, maybe 50 times, something like that. By itself, that's expensive. But if you look at it through the price earnings to growth, you could see through this practical indicator that it was actually really cheap compared to its growth. So it's good to look at these 3 indicators. I'll discuss this price to sales ratio later. I'll also talk a bit more about this when I cover valuation related to sales. Next, this part might be a bit difficult among today's early United States market content, but I think it'll be very helpful if you know it. I decided to interpret the price earnings ratio indicator differently based on growth stage, so I split it into 3 categories. So high growth companies that are steadily growing. This basically refers to earnings per share in simple terms, meaning that sales are increasing as earnings per share. For mature companies, which we often call value stocks, you can see that the slope itself is a bit gentle. High growth companies also have a somewhat gentle slope. It's a section that rises sharply. Mature companies do grow, but they steadily go up by about 10% or 15% in a stable way. These are the kinds of mature companies I'm talking about. Next, for companies with worsening performance, their earnings per share stalls, and then their forward earnings per share starts to decline. I've summarized how the price earnings ratio changes for these companies and how you can use the price earnings to growth ratio to make good judgments. So the first is, it's a high growth company. I wrote it out as a formula here, so it might be a bit confusing. A company that is growing. The trailing PE is naturally higher than the forward PE because the forward PE uses the expected earnings per share. But since it's a high growth company, the earnings per share naturally increases, so the PE ratio becomes lower in this case. Because the PE ratio is price divided by earnings, and for high growth companies, the forward earnings go up. As earnings rise, the forward PE ratio decreases, so the current price compared to the future trailing PE is lower. The forward PE ratio will always be lower in the future due to high growth companies' characteristics. So the higher the growth of a company, the bigger this gap will be, much more, because as the earnings per share increases a lot, the PE ratio will drop even more. Since the rate at which this PE ratio drops is much higher, the bigger this gap or this ratio is, the more you can see that the company is experiencing high growth. So, second, when you look at this price earnings to growth indicator for these high growth companies, if it's generally 1 or below 0, you can judge that the company is undervalued. Earlier, NVIDIA was at 57 or 58, but for example, if NVIDIA's earnings per share growth rate is still over 60%, then you can evaluate it as just reasonable, not extremely expensive. If you only consider the current price-earnings ratio and ignore growth rate or outlook, your judgment will suffer and you'll be wrong. Some say a price-earnings ratio of 50 is expensive for some companies, but 80 is cheap for others. So what's the actual standard? Then people end up thinking that price-earnings ratio is completely useless, but it's definitely not a useless indicator. So I think it would be good to make this distinction. The second type is growth companies. Growth companies are, of course, the trailing price-earnings ratio is a bit higher. For growth companies, since their earnings per share is rising like this, the forward price-earnings ratio is indeed lower. But the difference from the trailing price-earnings ratio isn't that big. So that's the forward price-earnings ratio and the trailing price-earnings ratio. Earlier, we had those two initial sides, right? If they're similar, it's likely not about growth rate. Check the earnings per share growth rate. If it's significantly different, it's a growth issue. Then look at the price earnings to growth ratio. If growth is 5%, but price earnings to growth is under 1, it may be undervalued. The most accurate way is to check the valuation band chart on our site. Now that we provide it, that's the right thing to look at, but even when you're just skimming through, those things alone are enough for you to make a judgment. And these mature companies, the price earnings to growth goes over 1, and it can even go up to 1.5. So it's not because the stock price is high, but because this is low, because the growth rate is low when you divide price earnings ratio by, when using the gross growth rate, since the growth rate is low, your price earnings to growth ratio rises. This happens. For these guys, the price earnings to growth ratio is between 1.0 and 1.5, which is usually seen as normal. It's a typical figure, you can see it that way. Third, companies with deteriorating performance. They grew up until this year with about 20% growth this year. Our website displays the forward value and earnings per share as a bar graph for the next 3 years. When you look at it there, you can see their performance drops from 20% to 10%, then to 8%. This company's performance is declining, which is the opposite trend of improving companies. Since earnings per share is dropping, the forward price earnings ratio is higher due to the low earnings per share. So for these kinds of companies, if you look at the price earnings to growth ratio, it often goes over 2 or even higher. Even for high growth companies, if the stock price is too high, the price for earnings to growth can reach 4 or 5. But that's just talking about these growth stocks. And when it's 1.0, it means it's cheap. Saying it's cheap doesn't mean it can't go over 1.0. Of course, it should go over 1.0. From an investment standpoint, below 1.0 is undervalued. For most companies, above 1.0 means overvalued, and that's usually accurate. Looking at the last subtitle screen, I'm going to move to the actual website and talk a bit more. I think this screen will be very helpful for you when you actually invest. I've summarized earnings per share growth rate into 4 points. The relationship between earnings per share growth rate and price earnings ratio, these 4 points, make sure to capture this screen. It would be good to keep this in mind. The first is the higher the earnings per share growth rate, the higher the price earnings ratio of the company naturally. So when looking at price earnings ratio, you can't just say one company is at 50 times, another is at 40 times, so this one is cheaper. That's not how it works. A higher earnings per share growth rate naturally leads to a higher price earnings ratio. That means you need to understand that there can be companies that are cheap even with a price earnings ratio of 80, and companies that are expensive even with a price earnings ratio of 15. Let go of judging something as expensive or cheap solely based on the absolute number. It would be good to remember that depending on the growth rate, the higher the growth, the higher the earnings per share of the company. The second is the sustainability of the earnings per share growth rate. Yes, this is something that's not often covered even in books. What this means is, in the previous step, it's simply that when the earnings per share growth rate is high, of course you get a high price earnings ratio. The second point is the sustainability of the earnings per share growth rate. What sustainability means is, let's say, company A can maintain an earnings per share growth rate of 30% for 10 years, but for company B, we don't know about 10 years, but for about 4 years, its earnings per share might increase by 100% each year. Then, between these two companies, which one would actually be given a higher price earnings ratio? If you look at it that way, the company with higher sustainability will have a much higher price earnings ratio. These companies, so sometimes you might see a company that doesn't have a high growth rate, but you wonder why it gets such a high price earnings ratio. It's just that its growth rate seems like it will last forever. Even if the growth rate isn't very high, for example, if it's around 18% and seems like it will last forever, these kinds of companies tend to have a very high price earnings ratio. So when we say the sustainability of earnings per share is high, it means the business model for earnings per share is very solid, and the company's monopoly power or economic moat is very strong. On the other hand, cyclical companies can't get a high valuation here, because for cyclical companies, the sustainability of earnings per share growth rate is low. That's because it goes up and down repeatedly, so you have to apply a valuation that matches that. Sustainability essentially means reliable profits. The more assured the profits, the more people will buy, even if yields drop slightly, making the multiple much higher. So the higher the growth rate and the higher the sustainability, the higher the premium you get. I'll discuss this next time. I'll also talk about this when I cover return on equity and price to book ratio. For United States stocks, price to book ratio is rarely considered and is even less relevant than for Korean stocks. Some companies buy back and cancel their shares, sometimes resulting in negative equity and ambiguity. Price earnings ratio, even though I won't explain it right now, might be a bit difficult to understand. Return on equity divided by price to book ratio equals price earnings ratio. So it's inconsistent to consider price earnings ratio but ignore price to book ratio. And when you look at price earnings ratio, you're really considering both return on equity and price to book ratio together. Separating price earnings ratio gives you return on equity and price to book ratio, and combining them gives you price earnings ratio. So analyzing price earnings ratio means assessing both return on equity and price to book ratio. Similarly, the sustainability of return on equity, much like earnings per share growth rate, increases price to book ratio as it becomes higher and more stable. United States stocks sometimes have a price to book ratio as high as 20, which surprised me when I started investing, since I thought I was calculating the price earnings ratio incorrectly. Because in Korean stocks, even a price earnings ratio of 20 times was considered expensive, and if the price to book ratio went over 2 or 3 times, it was seen as a pretty expensive company. But I realized there are a lot of United States companies that are still considered cheap. If the price earnings ratio is 15, that's fine. But I saw a price earnings ratio and price to book ratio of 12. I wondered why price to book ratio was 12 and found the return on equity was 80%. I guess it has to be that way. There's sustainability in that, and I'll show you with a chart next time as the period extends. Why it must decrease over time, and a high price to book ratio is essentially the same as raising the price to book ratio. So when you look at a business, Buffett is like that too. He says he's a business analyst. He calls himself a business analyst. Not just as a stock investor. The chief executive officer analyzes these kinds of stories too. And when you examine this story, this company is expensive at current numbers. If you think this kind of sustainability will continue for years to come, then the current PDR might not be a problem at all. Even if it seems expensive now, it's likely to become a cheap stock in a few years. So the person who invested in this way was Charlie Munger. Warren Buffett and Charlie Munger had completely different styles, but Charlie Munger used this style, and thanks to Charlie Munger, Warren Buffett. The reason Warren Buffett became someone who could buy stocks with a price-to-book ratio of 3 or 4, in other words, became an upgraded investor, is because Charlie Munger was actually the one who broke through this mindset. Charlie Munger has also written books, which is why this is important. For things that are sustainable and long-lasting, don't focus on the current multiple. Such companies may become undervalued after a few years, but since their stock prices keep rising, the expected undervalued price never actually appears. Charlie Munger argues that, although it seems expensive now, it's the cheapest it'll be, so buy it and assume it won't rise for about 2 years. So I think those aspects can be very important points when investing in United States growth stocks. And the third is, It would be good to keep this in mind as well. The long-term average annual growth rate of earnings per share, in other words, the average annual growth rate is not 50% or 20% per year, but when you stretch the period from start to finish, the average annual growth rate and the appropriate PE ratio you can give to that company are almost identical. Theoretically, it has to be that way. But what that means is, if this company's long-term earnings per share growth rate is 50%, then that means you can give this company a fair price earnings ratio of 50 times. You know, what this means is it's the same as what I explained earlier with price earnings to growth, which is a simpler way to put it. Earlier, I mentioned price earnings to growth being 1 or 0, and when price earnings to growth is 1, it means the price earnings ratio and the growth rate are the same. When we say it's 1, it means the earnings per share growth rate and price earnings ratio are both given and equal. So it's the long-term average annual growth rate. If the long-term average annual growth rate is about 50%, then the appropriate price earnings ratio for this company is just 50 times. That's a perfect fit for an official formula. First, estimating the average annual earnings per share growth rate is crucial. And finally, despite all that, depending on the current interest rates or the market sentiment, whether it's a greedy or fearful atmosphere, the appropriate price-earnings ratio can be greatly expanded or reduced. This is the same concept as Mr. Market that I mentioned last time, so it would be good if you keep these concepts of price-earnings ratio and earnings per share growth rate in mind. If you look at the indicator below, you'll see that I drew these arrows on the picture myself one by one this morning. As you can see here, I drew the earnings per share growth rate in blue like this. It's not common for the earnings per share growth rate to go straight up in a line. Let's say a company has a growth rate that briefly pauses, then rises again in steps. If there is an earnings per share growth rate, and if this is the long-term earnings per share growth rate, this chart shows that the price-earnings ratio should basically match the dotted line I drew here. So earnings per share growth is 50%, then this company will get a price-earnings ratio of 50. But that 50 times means it's 50 times this year's earnings per share, and it's also 50 times next year's earnings per share. It's currently multiplied by 50, but it seems a bit expensive. Even so, if next year's earnings per share grows by 50%, and you multiply that earnings per share by 50, the current stock price could actually be cheap. So when I calculate the fair stock price, as I said before, it's different from the target stock price. Are we discussing the fair stock price on a trailing or forward basis? I determine a stock's fair price by multiplying its expected earnings per share in 2 years by the appropriate price-earnings ratio, then decide if it's undervalued or fairly valued. Because overvaluation definitions change, we should discuss standards together when deciding if something is expensive or cheap. While it's subjective, there is still a standard. But how does the market actually move? Take a look at what happens when something is really expensive. If the stock market moved like this, there wouldn't be anyone acting like that, right? If earnings per share grows 30%, the multiple is 30, so you may think, I just need to find more stocks like this. The problem is, when the earnings per share growth rate rises, the actual price-earnings ratio increases even more. When growth slows, it's the earnings per share that stops, not the price-earnings ratio, Han-Hyo-Jung. It means they give a much lower appropriate price-earnings ratio, so you need to understand this concept. That's what it means. Suppose we expected this company's earnings per share growth rate to be 50%. If so, the suitable price-earnings ratio is also 50 times, so we plan to use that. Even with a 50% earnings per share growth rate, it doesn't reach 50% each year. Some years, unexpectedly, it reached 70%, but the following year it could drop to 30%, so the long-term average remains 50%. So it would be great if the price-earnings ratio just went straight to 50 times, but at this point, the price-earnings ratio jumps right up to 70 times. The price-earnings ratio jumps to 70 times, but then the earnings per share growth rate drops to 40%. That's still a high growth rate, but the price-earnings ratio drops from 70 to 40. Sometimes the stock price stays flat or falls, even if earnings per share rises. Investors might say, earnings per share increased 40% this year, but the stock dropped 15%. How does earnings per share relate to stock price? That's the typical discussion. So in these cases, the actual price-earnings ratio rises more or falls more when the earnings per share growth rate accelerates or decelerates. So these kinds of things, If you actually want to make an estimate, what you can do is, well, this isn't really something for elementary school level, but we do cover this part. We use the earnings per share growth rate and the past long term, the earnings per share growth rate and PE ratio of a specific company, and then we derive a regression equation with those two. The regression equation shows whether there is a linear relationship between the two. Then you'll get values like the slope and intercept, which we learned about in math class, and other values that might sound unfamiliar. What this tells you is, for example, if this company's earnings per share growth rate changes by 1 percentage point, you can estimate how many times the PE ratio will change as a result. So when we look at valuation, if the growth rate increases, we say that we give it more weight, and these kinds of factors are reflected in the process. That's why in our valuation, the reason high growth stocks come out much more expensive compared to Morningstar is because we've built algorithms that give more weight to growth rates. So we don't think our model is complete yet either. Recently we updated our valuation algorithm and we'll be updating it again soon. We're constantly trying to find and refine the right standards. When you look at this, you'll see the price-earnings ratio changes as the earnings per share growth rate rises, which is clear from the numbers. If you try this with just one stock, you'll understand that everything I've said is accurate and theoretically this is 100% correct. But you also need to understand that the actual price-earnings ratio moves this way. When growth speeds up, you may wonder, it was 50 times before, so should we sell at 70 times now? Will it reach 70 times? If it hits 70%, it can go up to 70 or even 80 times. Since it grew by up to 70%, could it be 80% next year? If the earnings per share growth rate is like that, then that's what people's consensus becomes. Because we are Mr. Market, so if more people believe in that, it just goes to 80 times. So a gap occurs between what's rational and what's real, but investors can find investment opportunities in that gap. Actually, it's not that I can't invest because of Mr. Market, but rather because of Mr. Market, I should study so that I can become someone who can find investment opportunities. Reflect and think about it. This company's more sustainable business justifies a higher PDR than the other company. That's the idea. Rather than doing a formal discounted cash flow valuation, calculating everything, dividing and figuring out the discount rate, this gives you a much more intuitive valuation and will probably help you judge whether something is cheap or expensive. I'll wrap up the theory lesson here, and on our website, let's review just once by looking at a real example that's available, and then we'll wrap up.
Yes, before we move on to the website, I have a good example, so let me add a brief comment. The most important thing right now, the part we need to apply when actually investing, is to remember that as the earnings per share growth rate changes, the PDR moves along with it. That's one of the main messages for today. But the best example here is actually Nvidia. There's a reason why Nvidia's growth rate goes up and down like this. Because it's a semiconductor company, so recently that tendency has decreased a bit. Because now there's a structural growth driver called artificial intelligence, and Nvidia has been releasing new chips once a year since last year. So the cycle has almost started to disappear. In the past, we usually called new products architectures, right? They used to upgrade the architecture every 2 years and release new GPU chips, which created a 2-year cycle. When a new architecture comes out, it costs a huge amount, and because it's newly released, there's a bit of a gap in sales. Because people wait and don't buy until the new product comes out, the growth rate drops significantly from just before the new product is released until it actually comes out. Then, once the new product is released and starts selling well, sales suddenly increase. That happened every 2 years. So, if you hear the names, you might remember. About 4 years ago, there was something called Ampeo, and Ampeo moved on to Hofo. And recently, the one getting a lot of attention is Black Elm. So, when Ampeo first came out, Nvidia's stock price dropped by more than 50%, and when Hofo came out, it dropped by 70%. That was in 2022, and now there was another time when it faltered, right? especially in April when Trump's speech didn't go well. So it's important to remember what stage we're at now. Yesterday, I saw the ranking growth rate in the cause and effect, and it was 59%. But earlier, Chief Executive Officer Nip, you said the price earnings ratio is about 57, right? So the growth rate is actually higher than the price earnings ratio. What that means is this quarter, 50% grew by 9%, but next quarter, there's a possibility it could go up even more. Because the era of Black L has just begun. So if the growth rate goes over 60%, like you said, the price earnings ratio will follow the earnings per share growth rate. A company like Nvidia has the potential for its earnings per share to increase even more as its earnings per share changes. At least that's what history shows. Whenever new chips started selling in earnest, the stock price always surged. So if we keep this in mind, we might realize that Nvidia's current 57x valuation might not actually be expensive. I wanted to give this example to explain that.
Thank you for giving such a good example. I had originally prepared to talk about a different company, but I changed my mind and decided to take a look at Nvidia instead.
Yes.
I'll just go ahead and click on Nvidia. Can you see the Nvidia subtitles? Yes.
I can see it clearly.
Currently, it's down 1.3% pre-market. So today, for our review, I'm only going to go over this part. I'm just going to review this part. Here we have a price earnings ratio of 51 times. You need to clearly understand what this means. So people might say things like NVIDIA has 51 years, but what's more important than just this number is that you have to look at it together with the growth rate. This is called the trailing price earnings ratio. It's the sum of the most recent 4 quarters. And if you look here, it says forward, right? Yes, 43 times. So look, the price earnings ratio is higher than the forward price earnings ratio, right? And if you look at it, there's about a 20% difference right now. This ratio itself is about 20% higher. Since this price earnings ratio is about 10 points higher than the forward price earnings ratio, it's roughly about 20%, maybe 17% higher. So for this to be considered a high growth company, this gap needs to widen a lot, right? It needs to widen like this. So you have to see it as NVIDIA's forward outlook is still alive for now. Next, the second system growth rate. How much was it this time? 59.
It's 59%.
Is it 59%? If it's 59%, as you can see here for this year, now for 2026, this is a company with a January fiscal year. It says here that it's expected to grow by 41% compared to last year. How these estimates will gradually change is also going to be a very important point. So right now it's 59%, and if the third quarter next year, I mean the next quarter, is also 59%, then this growth rate will probably go up little by little as well as analysts' estimates change. That's why I said we need to track what's called the earnings per share revision, and I also mentioned that someday we'll add it to our website. I don't want to add it like other companies, since just displaying it doesn't offer real value to investors. So how can we make a more meaningful visualization? That's why I haven't done it yet. I haven't found the answer. But showing the earnings per share revision well is really important. It's 41%, and as mentioned earlier, the growth rate is... If we look at this, the growth rate is 41% on an annual basis. It's 41%. And then if we look at the current forward price earnings ratio, it's about 43 times. So the price earnings to growth comes out to about 1.24 times. Then it's just a bit more expensive than the fair value at this level. So when you look at high growth companies, you can say it's slightly overvalued compared to the fair value. Then if you look at the next year, now this forward price earnings ratio is the forward price earnings ratio at this point. And let's say we move on to the next one after this. Let's say, for example, we're investors looking at 2028. Then about how much is left now? These investors have around 2 years left. Earnings per share is $6.4 and the stock is $181, correct? Then if we divide to get the price earnings ratio, let me check with a calculator. I'll just calculate the price earnings ratio with the stock price. $181 divided by $6.46, so the price earnings ratio is 28 times. So, based on 2028, this is what it means. By 2028, this company will have a price earnings ratio of 28 times. So, will it grow by about 28% by then? I think it will exceed 28%. If that's the case, it's a good company, right? That's how you judge it. For me, 2028 feels too far off, so I'll focus on 2027. By then, the company will already have grown and be in a position of growth. The price earnings ratio itself is 5, and with $180, that's roughly about 30, maybe a bit more. Should we calculate it? It's about 3 or 4 times. Just in case anyone is curious, I'll do the calculation. It's 553, so 32 times. So the 2027 forward price earnings ratio is 32 times at the current stock price. Now, the expected earnings per share growth rate is 33%. If you divide by that, it's about the same. That's basically what it means. So it means it's a bit different from saying it's highly overvalued. However, the growth rate is because the company is so profitable, it can't possibly capture all profits on Earth. That's why the growth rate will eventually decline. The fact that this growth rate drops from 41 to 33 and then down to 16% in 2028 is something we need to keep in mind in a year or two. So right now, the growth rate is still incredibly strong, and we're seeing earnings surprises. By 2028, we need both growth rates and earnings per share revisions to rise together. Earlier, the actual price earnings ratio stays higher than the fair price earnings ratio. If the market consensus starts to believe that, with a price earnings ratio of 30, it's now difficult to achieve a 30% growth rate, then the stock could drop significantly. That's why you should also check the changes in growth rate, called earnings per share revision, because we're not really investing based on 2028 right now. To be honest, even if we buy here right now, if the stock drops 20% in a month or two, should we sell? I expect to get many questions like this. If things will drop in 2028, shouldn't we avoid buying stocks now? So I used to ask people like that during my lectures, are you really analyzing now with the intention of investing until then? I asked them, every company faces risks, each with its own. CEOs do things like M&A, restructuring, or even selling off parts of the company to deal with declining growth rates. They make these kinds of adjustments. But analysts can't predict what this company will be doing in 2 years. So the period we really need to focus on is at most 2 years. If it's short, about a year, it won't be too far off. During that time, monitor valuation changes and if growth meets expectations. Once you need to check next year's results, focus more closely on the growth rate from then on. If you use indicators like price earnings ratio versus earnings per share forward price earnings ratio and price earnings to growth from that perspective, you can make judgments about valuation more quantitatively without having to calculate things like discount rates or future free cash flow, and I think that's much more important. So I think it would be good for you to try those things out. That's all for today's class.
I think that's it. It was a lot of fun, especially since the earnings announcement was just yesterday. I think it was really interesting. Could you turn on that screen for a moment, the choice stop one? Because there were a few numbers written here, and I see two interesting numbers. First, if you look at the earnings per share for 2026, it shows 4 and 15, but these aren't numbers written by the Chief Executive Officer, they're analysts' forecasts. But in this quarter, the earnings per share, based on generally accepted accounting principles, came out to 1.08. If 1.08 continues for the next few quarters, even without growth, multiplying by 4 gives 4.3. But that's not going to happen. Nvidia is a company that grows at least 10% every quarter. You can just assume that there's no chance it'll be 4.15 and maybe up to 4.5 is possible because it's only the third quarter now, so the third, fourth, and second quarters are left. If all goes well, it might reach 4.5. So we use this earnings per share to calculate the price-earnings ratio, but one more thing. As far as I remember, you'll show us later how this figure changes on choice stop, right? So I think it's really important to see how this figure changes. The consensus is 4.15, but I think that's much too low. And there's one more thing. Let's scroll up for a moment. You know the revenue, right? If you look at 2028, it's listed as 301. And since that's in billions, that's $301 billion. But in that earnings call, what Jensen Huang said was that by 2030, artificial intelligence infrastructure investment could reach 3 trillion or even up to $4 trillion if things go well. So then an analyst asked, if the total is 3 to 4 trillion, how much of that will Nvidia take? He said about 60 to 70%. What that means is if it's $4 trillion, that's 2.8 trillion, right? 2.8 trillion. But right now, the projected revenue for 2028 isn't even close to $1 trillion. It's only 300 billion. That's a huge gap. Right now, market analysts are overestimating Nvidia's future revenue. We should see it as somewhat underestimated because
21 people are definitely wrong.
they're completely wrong.
Jensen Huang might have exaggerated too much about 2030, for example, assuming there won't be any competitors until then, and estimating a 70% share. That could be right, but in the market, there are other competitors. Recently, if you look at companies like Google, they're making their own TPUs instead of GPUs, so they're able to lower token costs and achieve some results. So even yesterday, I saw that they launched an image generation service like that. They launched one at Google Gemini using TPUs instead of GPUs because GPUs are expensive. Through that, I went to the Google Cloud Conference in Korea last time and I listened to some explanations and they talked a lot about things like that. So by optimizing TPUs, they're setting up their cloud in a way that gets better results than GPUs, and they're really pushing this as a business. They talked a lot about using various artificial intelligence engines and things like that. So I realized that Google is also doing things quite aggressively. Anyway, among the big tech companies, the one that stood out to me the most was, for me, it was Google. Next was Meta. So personally, my top pick is Google because they kept pushing in this direction and now it feels like they're finally about to break through with something sharp. Nvidia is taking a slightly different approach. If Nvidia truly becomes that company, by 2003, I think these numbers will change very quickly. The sales growth rate would probably have to change by about 60% or so. So we'll keep tracking whether those things are changing. Actually, Nvidia is also included in the portfolio we recommended. We're monitoring it closely in the current situation. If you look at the trading signals for this one, it's still... If you look here, a buy signal appeared for this one at $117. Right now it's up about 50% and the price is holding steady. If you look at it just based on valuation, until yesterday it was overvalued. Until yesterday. Because it was touching the top here, this Nvidia. Now it's tough. And then like this, it was steady, but then the fair stock price suddenly jumped here.
The guidance goes up.
When the earnings change, we update them right away if our earnings change. We do it really quickly, so as it gets updated, suddenly this one has fallen below fair value as shown. Let's take a look in here.
Exactly, since it's gone down.
It was here before, but moved here. Since supply and demand haven't collapsed, it's still giving a hold opinion, and the trading signals remain the same. Those trading signals can't all be checked by people who review fundamentals, valuations, and supply and demand. Now, since there's no time or capacity for these things, if you keep this in mind, so this is how it changed. This company's value went up, so its fair stock price increased. Since the earnings per share growth rate is rising, that part is going up too. If you look at these things, whether it's our site or other sites, there are places that show these fundamentals. When you look at that, you'll probably be able to interpret it much more richly and thoroughly. Yes, that's good.
Now, I really hope that in the near future, changes in the consensus will be reflected quickly. As a Choic Sutak user, I kind of... Should I say it's early evening since it's been a while for us today? We started recording at 8 o'clock. How was it? The show.
It's really quite lively. Actually, this is about the time we should be starting now. There's still a lot left, so at home,
Let's at least do the dishes.
it's all done. So let's have some tea and talk. Have some conversations we couldn't have before.
Yes, then be a beloved husband. I'll be waiting for another good lecture next week. And I'll try to endure the week. You've worked hard, and I'll see you next week. Thank you. Good job.
Thank you very much. I appreciate it.
The start of a small dream is important. Shall we plant a hopeful future together, growing little by little every day? Is there excitement in your heart? Let go of greed. It won't be any different this time. The result continues the process. Even if dark times come, I'm not afraid. I'll move forward holding Miju's hand. I'll become the light of tomorrow that you can't see. A happy investment, supporting each other's dreams. Let's walk together down this beautiful downhill path. A happy investment, together with Miju, until the day we all dare to retire with national stocks all together.
Subtitled by Badal Minjo.